All right, everybody, welcome back to another episode of the Discovering Multifamily podcast. I'm one of your hosts, Anthony Scandariato with Red Knight Properties. And today we have a special guest here. Well, not here with us, but he's across the country in Ireland, and really excited to have him, Gavin Gallagher. He's got more than 25 years of experience in the real estate sector, investing, developing, promoting, and managing different types of asset classes. He's a veteran of multiple boom bust cycles and has a lot of wonderful scars to prove it. And we're going to discuss some of those scars, especially in 2008, 2009 financial crisis. And he's a great person to connect with. He's got, like I said, a ton of experience. He's got his own podcast too, called Behind the Facade. So definitely check that out. It's definitely one of the top financial education, business and investing podcasts in Ireland right now. And just really excited to have him. And today we're going to talk about what happened in 2008, 2009. We're recording this early 2022. So if some of the same things are happening, what type of lessons has he learned, Gavin has learned in his past, and just going to be a really fun and interesting story. So Gavin, thanks for coming on.
Anthony, it's a pleasure.
Excellent. So you've been here for 25 years. So you've seen multiple real estate cycles. We're in 2022 now. When people talk about crashes in real estate, does it happen very quickly or is it a little bit slower? What was your experience 2008, 2009, and how can you educate us?
Yeah, well, I'll tell you what the thing is there's a kind of a bit of a build up to kind of the lessons that I've learned from it, and you've got to be with the real estate business. It can be very, very rewarding, and you can just find yourself in the right place at the right time, and you can land these tremendous deals that provide this huge, payouts in one, much bigger than you might have ever expected. There was a couple of deals I did where I thought I would make a couple of 100,000, and they delivered 2 or 3 million, and it was like very shocking, unexpected. But these windfalls occasionally happen. And when I was starting out in my career, Ireland was going through this kind of very, very rapid increase in its in the value of property. And we had come from the high interest rates of the 1980s into the 1990s, and Ireland had been quite a depressed kind of economy prior to that. And then suddenly we became part of the euro, and the whole economy just took off. And I was there to kind of ride that kind of wave, and it was exciting time. And I kind of went and I leveraged up on a couple of deals, and they just all went really, really well. And the problem with that kind of a start in your career is that it can lead to complacency, and you can kind of start to think that you're a genius and that it's all down to your decision making and your kind of skills, when in fact, a rising tide lifts all boats, and it may not be something that you're specifically doing. It might just be that the entire market is overheating and you're part of that. But you don't always see it like that. And this is one of the things that I try to talk about in my own podcast. The reason I called it Behind the Facade is that there's an awful lot going on behind the facade. And I try to get people just to think outside of the situation, to kind of become unemotionally attached to the situation you're in and just look at it from an objective point of view, and just try to sort of say, hold on a second, am I doing everything right here, or is there something more happening? Is the entire market, is the market doing more here than I am personally doing? And this is something that I was lacking at the time, and I thought that I was just this genius who had figured out the secret formula to becoming a multimillionaire. And it was working really, really well for a couple of years. Then around about 2006, and that is when I started to double down and start to scale up my business in a big way. I added a load of extra staff people to my team, and I really was planning on this, scaling up my whole operation quite significantly. And what happened very quickly was I realized that I follow the news cycles very, very closely. And I'm always watching, even though I'm over here in Ireland, I'm actually watching what's happening in the US all the time. And I have, regularly every single day of the week, I'm watching YouTube, videos that different personalities are putting out about either the stock market or the financial markets or the real estate market. And as I was watching all of these kind of channels, I was just noticing more and more talk about the subprime mortgage sort of crisis that was developing. And what was interesting from my point of view is my instincts when I started to hear about this more and more was that, there's trouble on the horizon. But the problem is that most people didn't seem to have the same opinion as me. Most people were, look, that's nothing to do with us. That's on the other side of the Atlantic. It's not going to impact us. And I was watching this and I started to just feel a little bit nervous. But the problem is, by that stage, I had a huge number of projects in the middle of development, and you can't just turn off a project straight away. I had some projects that were a hole in the ground and it was contractors kind of, pouring foundations. That is not something that you can just simply turn off, and you have to finish out the project before you can sell it or before you can lease it or whatever. So I had multiple projects at stages like that. And I started to feel this sense of, I'm not liking the news that's coming out. And sure enough, things got progressively worse. And it was slowly but surely starting to become more and more negative. I remember I was selling a property, and I had bought this property for about 5 million, and I had made a nice sort of turn, and I had a contracted sale at 8.2 million. So 3.2 million profit. And I thought to myself, I'm going to sell this property. I'm going to put the money in the bank, and then I'm going to have myself my war chest for if there is a downturn, I'll be in a good position. So whilst I was waiting for that sale to happen, I was continuing on managing all my projects. And then the sale fell through. And the person that was buying it from me was one of these big names that if you were here in the Irish market, everyone would know who this person was. It was a very big kind of name in the property industry. And when he pulled out, I was like, I wonder why he's pulled out. And I was in the middle of transacting on another deal, and that fell out as well. And that was going to bring in something like a little over $1 million in profit. And I was thinking to myself, this is not good. This war chest that I thought I was about to have is going to it has now disappeared, and I'm feeling a little bit nervous. And anyway, it continued to get on, and then suddenly Lehman Brothers happened. And when Lehman Brothers happened, I was in the middle of closing a transaction in the south of Spain, and I had just contracted to buy a project for 42 million euro, and I suppose that's probably around $50 million. And it was half constructed at the time that I transacted on it. And I can remember at the time I had multiple tenants agreed to enter into this deal. And within a couple of days, they were starting to pull out of the deal because Lehman Brothers it had this transformative effect on the way people were looking at their capital expenditure budgets and all this. And just suddenly people were dropping out. And when one would drop out, it triggered multiple others to drop out. There's these dependencies where I was trying to build a luxury retail boutique kind of parade down in the south of Spain. And it was going to have Gucci and Ralph Lauren and all these. And all of these guys had expressed a lot of interest in going into the location. And suddenly they were all pulling out because once one left, the rest of them wanted to leave as well. So suddenly I went from feeling very smug and very, successful, lots of money in the bank, lots of, income coming in, to suddenly I'm dealing with multiple fires in different countries, and people pulling out of deals, projects that are starting to dry up. The banks are starting to kind of tighten the faucet in terms of cash flow and stuff, and it just became very, very nerve-wracking. And that was just the beginning. That was just the very start of it in 2008. It didn't happen. It wasn't an overnight thing. It was this gradual, slow cut and cut. It was like a death by 1,000 cuts, I describe it, because I could see it coming. And then when Lehman Brothers happened and everyone started to enter into this like complete panic about the systemic shock to the system and the fact that this could bring down all the other banks. And I mean, I can remember it being very, very worrying. Certainly America was treating it very badly, but the impact on Ireland hadn't been felt yet. And suddenly then it started to kind of flow through to the Irish market. And it was painful because when tenants started pulling out, you started having to deal with multiple fires and firefighting every single day. And as it turns out, this went on for probably another 3 or 4 years. And it got to the point, at the worst point I can remember, I was having to prepare a statement of my financial affairs for a bank meeting. And I was actually living in Spain at the time, and I flew back to Dublin to sit down with my banks, and I prepared this financial statement. And I can remember just scratching my head and thinking, how have I've done something wrong here. I kept on running the numbers, and it kept coming up with a negative 16 million. That was my net worth. And I was just like, there must be something. I can't be negative 16 million. And I kept running the numbers again and again. And I found out that actually, the values have collapsed to such an extent that I'm actually negative 16 million in debt. And that was a shocking moment, because I'd been, the complete other side of that. I'd been sort of 7 and 8 figures in terms of having a portfolio that was very, very healthy. I didn't have huge debt levels, but the Irish market, some segments of the market actually fell by 60 to 70% in value. And especially the projects I mentioned that were under construction. And if it was under construction, the value completely dropped out of it. And oftentimes you weren't even given the money to finish the project. So instead of having a completed deal, you now have just this hole in the ground that's worth less than it would be if it wasn't a hole in the ground, and you've already spent money on making it a hole in the ground. So it was just a bit of a disaster. And slowly but surely, I started to realize that I'm in deep, deep trouble. And then it just became a kind of a fight for survival, and trying to it's like you're in a sinking ship and you're just trying everything to stay afloat. And it took the best part of 6 years to actually sort of get myself back on an even keel. So quite a difficult time.
Yes, no, absolutely. So it took 6 years so did you end up holding those properties, or did you had to liquidate some, or you couldn't because you were so underwater? Because you said some of them were under construction, so it's not like you had cash flow coming in on
That's
some of
the
them
thing.
to pay.
I had good cash flow from some rental properties that I was holding. But the problem is that the rental, when the banks started to get nervous and started to kind of pull in loans and stuff, they started to become very difficult. I had this fantastic relationship with all of my banks, and I used to send a Christmas hamper to all of my bank managers, and they'd get a big hamper with wine and all of these kind of things. And because it was so simple to get money from them, I would just pick up the phone and ring, and I need 2 or 3 million for the next transaction. And as simple as that phone call was, that's how quickly I would get the money. Suddenly they put new teams in. So you had new relationship managers, and these were totally new people, had no rapport with them whatsoever. And as opposed to being friendly and, wanting to do business with you, they had this very obstructionist kind of view. They kind of thought that you were a problem client. And that was the attitude that you met with from the first time you met them. They were like, when are you going to pay this loan? We're not giving you any more money. And so it was amazing how quickly the attitude changed. And you're trying to work with these people, and you're saying, look, this project, I can't get any value unless you give me, the loan to actually, complete this. And in some cases they did allow that, but in other cases they did not. And what they started to do was insist on liquidating some of the assets that were actually income producing. So they didn't want to liquidate the site that was under construction, but they wanted to liquidate the assets that actually were income producing, because you could sell those an awful lot easier. It's like they take they give you the umbrella when it's sunny, and then as soon as it's raining, they take the umbrella away.
So, just kind of speaking to that a little bit, when, you're looking at taking on additional debt, particularly in real estate for my audience, was that a mistake you made? Like, it sounds like it might have been cross collateralized.
That's the problem.
Yeah. Okay. So that was a big mistake.
The biggest mistake I made was those simple phone calls that I mentioned. The reason they were so simple is because I had agreed on the cross collateralization.
Great terms. Yes.
And it was just, if you want 2 million, Gavin, no problem at all. We've already got you cross secured on this other entity over here. And therefore that was that. And the problem is, at the time, that strategy had worked beautifully. I mean, I had amassed a huge kind of fortune in the space of just 5 years using that exact strategy. So when the market is good, it's just a fantastic way to be able to move quickly and strike fast. So when somebody wanted to sell a property, I could move in and I could have cash straight away to actually close the deal. If you were going the traditional route, you'd need to do credit reports, and you'd need to do all of this stuff that would delay it by 6 weeks. And there would be committee meetings, and all of that kind of stuff would delay it. Didn't give you the ability to strike quickly. So whilst the market was rising, this was a great strategy, and it allowed me to kind of do things quickly. But as soon as the market turned negative, it actually turned out to be like an anchor chain, and it dragged me down, and it just gave them all of these simple options out. They just thought, why don't we just sell this really attractive property, and that will bring in, a couple of million. And even though they might be selling it $1 million below what it was worth, it would still be a couple of million that they could use to kind of write down debt. And the problem is, once they've done that, any potential prospect of getting that kind of profit back, or that growth again in the future, is gone. So that was the worst thing. And the problem is you might think some of the advice I have, during my podcast, I try to kind of explain that. Don't think that the relationship you have with your bank today is the relationship you're going to have if there's any kind of a correction in the market. You might be best pals with, your bank manager and the guy who makes the decisions on your loans and stuff. But in the event of some sort of a downturn, the first thing they do is switch out all the relationship managers. And so suddenly it's a completely new face, has no relationship with you at all. And so he's dealing with maybe 20 new customers, and he's going to treat them all the very same. It doesn't matter how much business you've done with them in the past. And so suddenly you're trying to, come on, you kind of think that a lot of these, problems are not going to be problems because you can work with your bank manager. Suddenly they have a totally different attitude, totally different set of faces. And that's where it was that was the bit that caught me the most, because I thought I could work with these people.
Sounds like it. Yeah.
And suddenly you can't work with them at all. They're completely, they're just a different type of people altogether.
Yeah. And it's always prudent. And, were you just starting in the business at that time? It sounds 06.
It was early. I mean, what I had done was I had started in the kind of late 90s, and I had started slowly, and then around about 2002 I started to kind of ramp up, and it was just after the .com bubble had burst. Prices were quite low in Dublin, and so I bought a project. I bought a couple of projects within a couple of months of each other, and over the next 5 years, they all grew. Some of them 500% in value, and some of them were development projects that just really delivered very, very strong returns that we didn't even anticipate at the time. And so in the space of 5 years, we had added about maybe 15 million in profits to the business.
Oh, good. Because I was going to ask you, were some of those loans that were also, cross collateralized, during the 07, 08 period, did you also personally guarantee them? Or
yes, I personally. I mean, it's funny when you say that, because it sounds like a kind of stupid mistake. And when I say that now, people are like, "Why did you do that?" But you have to understand, at the time, this was the tax advice that we were given. And so one of the things that I try to kind of tell my my listeners in the podcast these days is that what's good today doesn't necessarily mean it's going to be good in the future. And so I used to go to, Deloitte, the big name that provides all the great tax advice. And I'd go to them and I'd say, can you tell me what's the best way to structure this particular deal? And they would come up with this very elaborate, structure, and they'd have this and that, they'd have all these kind of entities and stuff. But back then it was, you'd ask, what's the best way to do it? And they would say, buy it in your own name. Because if you buy it in your own name, when you sell it for a huge profit, which is what we were all doing, you're going to have one payment of capital gains tax. And so the increase here in Ireland, we don't have, I know in the US, you can roll over your gains and roll it into another. We don't have that facility here in the Irish market. So what we do instead is, at the time, we would pay 20% capital gains tax on our profits. And that would be, it'd be a one-time hit, and that would be it. And if you did it in a company, the company would pay 20%. And then if you wanted to access the cash in the company, you would have to liquidate the company, and then you would be hit again with another tax.
Okay. Yep.
And so there'd be a double hit. So the advice was, do everything in your personal name. There'll be one hit. And if you want to liquidate all these assets, it'll all be just cash straight into your pocket. You won't have any further, the only thing that would be better would be to do it through a pension, because there was no tax at all through a pension. But a lot of people want to be able to spend money on the lifestyle or improve their home or whatever. Right. And you obviously can't do any of that if it's in a pension.
Correct. So liquidity is a big factor. Very interesting. So looking back on all of that, obviously you came out of that, it took you a while to come out of that. 6 years. It seems like you rebounded pretty quickly. I know some folks who have, 10 years, 12 years.
Well, it took me 6 years to go from being negative to actually going back to zero. So when I say I didn't bounce back to being, the masters of the universe any longer. But it took about 6 years to go from this like dreadful negative situation to actually starting to feel like the light, I'd come out of the tunnel and I was finally back able to kind of start doing things.
Got it. So moving forward now into, 2022, some of the mistakes that were made in the past, and how can you help my audience? I mean, obviously, you have a great story, and how were you able to kind of, you went from negative to zero, and now I'm assuming you're back to kind of close to where you were before, or whatever, even past that. Do you see maybe from a market perspective, folks making mistakes of the past with, those types of, whether it's cheap debt, over leveraged debt, or, personally guaranteed debt, across debt, whatever, from a financing perspective, do you see the same type of crisis back then, like upcoming with, interest rate raises and bond tapering, or is it very different now?
I'll tell you what I think. I've been studying the market kind of closely for a while, and when I say I mean the US market. I watch it very closely, because we have this saying, if the US catches a cold, the rest of the world gets pneumonia.
Typically,
and that is and the Irish economy is hugely supported by American investors. We have we have billions coming in foreign direct investment into companies and into investment funds and stuff. So we're very much kind of tied to the ups and downs of the US market. And I've been watching it, and definitely the inflation. I think inflation is a big risk, and I'm getting this kind of foreboding feeling that it's going to be worse than you think. And that the Fed is going to have to react to it much more than they have. I just get this impression, and of course I could be completely wrong, but I just get this impression that nobody wants to admit how bad it is. Because if you remember back to 2008, everyone was sort of saying, yes, the Lehman Brothers collapse is bad, but we can easily weather this. This is not a major problem. And then within a couple of years, the whole market is on its head, and it's, or within a few months, the people jumping out of buildings and stuff. So it is very, first of all, the people in authority, they never tell you how bad it is. They always kind of want to give you a little bit of sugar with the difficult medicine. And so I found that, I just think that, talking about everything, first of all, everything was transitory. And then it's, okay, there's going to be 3 rate hikes this year. But then you hear Jamie Dimon saying 7. And then I saw this one of the hedge fund guys today, Ackerman, coming out saying that it should be 0.5% instead of 0.25%. And I think that something like that is possibly going to suddenly become an issue. And it's going to be, if we don't do something like this, we're just not going to be able to tackle this inflation issue. And I can't imagine it going back to the way it was with Volcker in the 80s, where you had 15% and things like that. Just because nobody's going to be able to pay. Like, the governments are probably the biggest debtors of all of us, and there's just simply no way they could cover that kind of debt. But all you need to do, if you're currently at 0 or 0.25 or whatever it is, if you're at that kind of level of interest and you need to tackle 7% inflation, you could be looking at 2 or 3% that you have to go to. And 2 or 3% knocks quite a bit of value off the deals that you're looking at. Yep. And so I know a lot of people that are out there, they've been chasing the market up. You're looking at an asset 3 years ago, you could have bought the asset for this price. Fast forward 3 years and it's now, this price plus X. And so people are having to dig deeper, they're having to spend more, and you become acclimatized to these higher prices. But every time you're looking at a deal, you're looking at it on the basis of what your payments are going to be on the debt. And unless you're kind of a more sophisticated and experienced investor, a lot of the time people just think that the payment that I have to make today is the payment that I have to make. They don't realize, unless you lock in your rates, and that is obviously a wise thing to do, is to lock in your rates for years ahead. But a lot of people, certainly one of the mistakes I made was that floating rates were much, much more attractive than locked in rates. And I can remember sort of looking at my debt, and I had quite a lot of debt at the time. And I remember sort of, should I lock in my rates? And I can remember doing the maths, and it was going to be a couple of 100,000 of difference in between income that I was getting in and not having it any longer, because it was going to go on payments for the locked in interest payments. And I can remember thinking to myself, whoa, do I want to voluntarily give up, 200,000 in profit? No, I don't. I'll stick with the floating rates and I'll take my chances. And so I enjoyed the 200,000 a year extra, but every time the interest rates were adjusted upwards, my profit kind of went a little bit lower and a little bit lower. And I can remember watching this, and every time there was a meeting of the Fed, or every time there was the ECB here in Europe, we have the European Central Bank. Every time they met, it was, we're going to incrementally add another 0.25%. And I can remember my 200,000 had become 50,000. And then I think the next rate increase was going to bring me to 0. And then the next one after that, I was going to be minus 50. And I was going to have to start putting money into the loans. And all of a sudden, you're looking back at that moment where you decided not to lock in. And you're thinking, why didn't I do that? Because the price now to lock in, when the rates have all moved up, the price to lock in is so much more expensive that you just can't afford it at that stage. And so it's a very painful decision. And I think people face those kind of decisions today as well. And it takes quite a lot of discipline, because one of the biggest problems with the property industry, if you work for somebody, you get paid and your tax is taken from your paycheck. So you get after-tax income. But when you get into the property industry, people pay you rent. They pay the full amount to you, and then you pay your debt. And then that little bit of wedge that's left, you're supposed to do your tax return on that. And so you might have to give some of that away. And so all of a sudden you're used to dealing with gross figures instead of the net figures. So this can make you a little bit more complacent, and you can start to live life a little bit more loosely. And I found that just all of a sudden, little things that, if you've got 200,000 a year extra income coming in because your interest rates are floating, suddenly it can be a little bit easier to live life. Your lifestyle changes a little bit. You can afford that nicer car, you can afford those more expensive holidays, and that creeps in. So you need to be quite a disciplined person to actually, resist all of that, because temptation, everyone says that they're very disciplined, but I study cognitive bias a lot. And there's a cognitive bias around temptation. And you tell yourself that you can resist temptation, but when it's dangling in front of you, most people actually can't resist it. And when it comes to having extra cash, or giving that cash up to pay off debt or something like that, it takes quite a disciplined person to do that.
Absolutely. Absolutely. And, I love what you said about, especially in times like these, locking in really low rates, still fixed rate debt. Don't get tempted by the variable rate. I mean, we do some variable rate, but like you said, you got to be very prudent, and it depends on where you start with that rate too, because, it's, you could be starting, kind of close to where you are on a fixed rate. And then once they start raising rates, you're going to be above that, and it's just going to wipe profits. Depends on the project too. Not saying it's a bad thing, but you just got to be careful. Like you're saying, the temptation to, overspend just because you have more, cash flow coming in, or, paying out more distributions than you should, just, not having as big of enough reserve because, oh, my payments are low. So I can only, I only need to reserve, 1 month of debt service plus taxes, insurance, rather than 2 or 3, then you really should be. So I love that, advice, moving forward, as much as you can, start locking in long-term fixed rate debt, even if it's a little bit more expensive. Gavin, this is really great. Definitely learned a lot. What's the best way for my audience to find you, learn more about you, and connect with you?
Anthony, that's very nice of you. So I have a website for me personally, Gavin J Gallagher, J for James, and my social media handle is Gavin J Gallagher. If you want to listen to my podcast, it's just called Behind the Facade, and it's available in all the usual spots where you can find podcasts.
It's awesome. Well, we're looking forward to it. And if you liked what you heard and or saw today, please give us a rating and review on iTunes. It helps Gavin and I get our message out to a greater audience. So we'd really appreciate that. And Gavin, thank you for spending time with us here today.
My pleasure, Anthony. Good to talk to you.